everyone. Welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I mean, the bottom line is that China wants access to as advanced chips as possible. And we, of course, are heavily dependent on their rare earth exports, and we need access to those. That's where a lot of complication builds into it, because while it's becoming very clear that there's going to be some kind of walk back on export controls by the Trump administration, we really can't be in a position of giving away too much.
I think the three big areas, obviously, is the savings areas. So issues like Medicaid, savings, which is really just slowing growth. These aren't cuts to the program. It will grow by over $1 trillion. Certainly discussions about SALT and the Inflation Reduction Act. Senators are weighing on that, but they're also looking at how they can make improvements.
I think there's two major results coming out of this. Number one is Apple's move for greater cohesion. The other thing is what we didn't see. And what we didn't see is like a whole bunch of steps where Apple really embraces that AI hype.
We got 1 hour to go until the market closes. So taking a look at the major averages here, we see middling gains today. The Dow is up almost 100 points, about 0.25%. The S&P 500 up about 0.5%. The NASDAQ also up about 0.5%. We see a little bit of a leg higher coming just in the last, I'll call it 10 minutes even or so. We continue to pay attention to the trade headlines, obviously, and to await CPI later this week.
Yeah, I mean, listen, it's a relatively quiet day when it comes to economic data, so we don't have those reports or headlines to kind of move off of. I do think, to your point, we're still watching closely U.S.-China trade talks. It's day 2 in London. I saw reports, Julie, that they were taking a break, but they were at least scheduled to resume starting right now. So you're still waiting for headlines out of that. I think investors maybe just thinking, well, at least they're engaging, at least they're talking, at least it feels like de-escalation, at least for now. To your point, all ahead of tomorrow, when we do have important economic data, which is that May CPI print.
Right, exactly. And one of the things that we're going to talk about, and I guess a little bit of a teaser of my chart of the day later, is what we have seen happen to volatility, which has really come down. This is just the intraday, but if you look at the year-to-date volatility, we had that spike, and it's really been on a slow path back towards a more average level. So maybe this a little bit of a preview of the summer, which tends to be more quiet, except when you get things like Brexit, for example, different summer surprises. But if we look at the stocks that are on the move today, for example, we like to look at the NASDAQ 100, Alphabet, one of the leaders that we're seeing in today's session, Tesla shares coming back ahead of its robotaxi launch, which is scheduled for tomorrow in Austin. Otherwise, you got kind of a mixed picture there with
Apple up about 6-7%, kind of muted there following the big developer show, which is ongoing. Of course, our own great Dan Howell, he's still there in Cupertino. He's going to bring us a live report.
Yeah, here's a 2-day look at the chart, which is not great, down about 0.6%. And then quick look here at the sectors in the S&P as well. Utilities and industrials down. Energy up pretty handily today, about 2%, as well as consumer discretionary. So, investors are now counting down to the release of the May Consumer Price Index report on Wednesday. Yahoo Finance's Ali Canal standing by with what to expect from those numbers. Hi, Ali.
Hey, Julie. Well, the big question is how much impact we will see from President Trump's tariffs, but it's been a bit muted so far. We are expected to see a slight uptick in consumer prices compared to the month of April. On a monthly basis, prices are expected to rise 0.2%, matching April's gain. Core inflation, though, which excludes food and energy, that's forecast to increase 0.3%, a slight pickup from last month. And then on a year-over-year basis, slightly hotter across the board. Headline inflation expected to come in at 2.4%. That's up from 2.3% in April, which was the lowest annual rate since early 2021. Meanwhile, annual core inflation, same story there, expected to clock in at 2.9%, also a touch hotter than last month. So although these upticks are relatively modest, the bigger story may be what's coming next. Wells Fargo said this report will, quote, be an important test of how quickly Trump's tariffs make their way to store shelves. And to that point, Wall Street is increasingly bracing for stronger inflation later this summer. Think June, July. Goldman Goldman Sachs sees tariffs providing a somewhat larger boost to monthly inflation ahead, especially in core goods. And historically speaking, price increases from tariffs tend to show up 2 to 3 months after implementation. So more pain ahead. That seems to be the expectation. That being said, though, economists have warned that Trump's stop-and-go tariff approach could actually delay the impact, but also make the eventual inflation response messier and more persistent. Fed officials, of course, are keeping a close watch on all of this, but for now, markets expect them to hold rates steady at next week's policy meeting, and we'll see later down the line if there's any changes to that outlook.
All right, thank you, Allie. Stocks edging higher today as markets, as well as the Fed, await Wednesday's CPI data. For more on what's next for investors and for what to expect from the Fed moving forward, let's welcome in now Kevin Mahn, Hennion and Walsh CIO. Kevin, always great to see you.
You as well, Josh. Hi, Jules.
So let's start there tomorrow with that May CPI print.
Yes.
You got CPI and then, of course, PPI. How important are these prints for the market? And what do you expect, Kevin?
I think they'll provide validation for what we learned about PCE just a week ago. We saw core PCE coming at 2.5%, the lowest it's been since 2021. We saw headline PCE coming at 2.1%. Remember, that's the Fed's preferred inflation gauge, and their target for inflation is 2%, so we're edging closer and closer to that number. Generally, CPI comes in a little bit higher, or actually a little bit lower than PCE. So I think what investors are going to find is that inflation is indeed cooling, will likely come in line with expectations, and that should provide even more potential for the Federal Reserve to start to cut interest rates. Not in June, but perhaps as early as July, more likely in September.
I mean, it feels like not just CPI, but it feels like the jobs report, that everything is sort of a placeholder now because we keep hearing from economists, we will see the tariff effect.
Right.
And it's starting to come in, but not really. So as an investor, if there's still data that we're waiting for, how do you sort of know what to pay attention to and when to pay attention to
I
it?
think we're going to learn a lot from the Fed next week. Remember, next week, their June meeting, we get an updated dot plot chart and an update on their summary of economic projections. Last time, in March, they were forecasting 2 rate cuts of 25 basis points each. I think they hold with that forecast. If they add another one, that'll certainly be a tailwind for the markets. At that point in time, they believe unemployment was going to rise to 4.4%. It's at 4.2% right now. They also forecasted, very interesting, that GDP growth is going to slow to 1.7%. So if in fact inflation is cooling, if there isn't a significant tariff impact on inflation, and if the economy is starting to slow, well, maybe the Fed should start cutting interest rates sooner than they would like to.
Well, let me ask you, I mean, President Trump has made his views very well known, Kevin. Right?
Yes,
He's putting
that's for
pressure
sure.
right on Powell, right? He's coming out and saying, you should be cutting, Powell. You should be cutting a full point.
Yeah.
What do you make of that advice?
It's hard to feel comfortable with a full 100 basis point cut right now. But if I look at the Fed funds target rate between 4.25% and 4.5%, we have core PCE at 2.5%. We've had 3 consecutive months of slowing job creations. The unemployment market is relatively strong right now, 4.2%. That's pretty close to full employment. But if in fact we have rates still here, the housing market is still struggling because rates are where they're at, and we have cooling inflation, perhaps we should at least consider a 25 basis point cut. Not a 100 basis point cut, but perhaps a 25 basis point cut.
Well, but so how do you then square that with what the effect of tariffs will be, right? Obviously, we've got the U.S. and China meeting. I haven't heard, I mean, there is a lot of back and forth on, the rare earth minerals, export controls. I haven't heard, and forgive me if I'm wrong, I haven't heard them say, we're going to get rid of the tariffs right now.
No, and you touched exactly upon the key component of what's coming out of the trade talks this week, rare earth minerals. Right now, China either produces or processes over 90% of the world's supply of rare earth minerals. Let me give you an example. There's a mineral that's used within magnets that are part of the F-35's construction by Lockheed Martin. That affects our national defense, right? We know that. We have to concede something to be able to ensure that we get rare earth minerals to continue with our auto manufacturers and continue with our defense contractors. So if nothing comes out of these trade talks this week, hopefully we give a little bit in terms of chips, lowering our export controls, and they give a little bit with respect to rare earth minerals. In terms of other tariffs, I think we're going to start seeing larger trade deals announced. What will those trade deals look like? I have no idea. But ultimately, I think it's going to be a net positive for the overall world's economy if we get some type of clarity on what the future looks like just in terms of tariffs and trade.
We had Kevin Polcari on recently, Kevin, and we were asking him, and he said, listen, in his opinion, this market cannot move meaningfully higher from these levels until you get a trade deal. Not a trade handshake, not a trade reprieve, but a trade deal. Your response to that?
Kenny's a good friend of mine. I would just remind Kenny that in May, the market went up by 6.03%, the best May since 1990. We've seen some follow through into June with the hopes that this isn't going to be as bad as we originally thought with respect to reciprocal
But
tariffs.
can't not as bad only take you so far?
Yes,
You got to have
100%
better, not just not as bad, but
Yeah.
like an actual step up at a certain point, don't
Yes,
you?
but I think that we do need specificity now, and we need some finality for the market to move higher. But for those investors who try and play that guessing game and wait on the sidelines until we have that finality, they run the risk of potentially missing out on another May. So trying to time the market, to me, I've been doing this 32 years. I can't time the market. It's an exercise in futility, right? But perhaps you reposition your portfolio to areas of the market that are a little bit more tariff resistant.
What would those be, Kevin?
How about AI? We continue to hear more and more AI infrastructure spend. I always say to my clients, follow the money. Where's the money going right now? It's going to AI infrastructure buildouts, whether it's data centers or cooling solutions, or even the utilities that supply the power, including nuclear power. How about defense? Good Lord. I mean, President Trump actually just outlined $1.1 trillion in defense spending in the new budget. Over the last year, there was a 10% increase across the globe in defense spending to a total of $2.7 trillion, the most highest annual
What's a
increase
name to play
since
that
the
in
Cold
your opinion?
World.
What's a defense name to play that?
So I'm going to go over this shortly,
Don't
too.
ruin the goodbye or
Oh,
goodbye.
I'm getting ahead of myself.
Yes, so I won't
Hold the
touch
name,
upon
hold the name.
that name, but other names to consider other than what I'm going to discuss in goodbye or goodbye. How about a name like General Dynamics that supplies munitions? How about Lockheed Martin, the maker of the F-35 fighter jet? How about Boeing, who's just awarded the F-47 fighter contract? And what I believe to be the future of military conflicts, unmanned, autonomous aircraft, autonomous warfare, and how about a company like Kratos Defense for that?
On the AI front, I'm just looking at the Mag 7 collectively. They haven't come all the way back this year, right? And so, as we get further into this AI trend, how should investors be thinking about how to play it?
It's a great question. I think investors need to realize that the AI road is a long one, and it's going to be filled with many potholes, and in all likelihood, there'll be more losers than winners. But we still are just in batting practice of a doubleheader, right? Batting practice involves the infrastructure build out. It's boring. We're talking about REITs. We're talking about HVAC cooling solution providers. I happen to visit the TSM plant out in Phoenix, Arizona, where NVIDIA is going to make their chips here in the US. It's massive. But we haven't seen any return on investment from the actual deployment of AI. That's coming during the doubleheader, but that's several years ahead of us. So look to invest now in the infrastructure build out, but don't ignore the potential ramifications of the software and the hardware providers from Microsoft and from other people like Amazon. Those are the names that where the puck is going. Where the puck is right now, data centers. It's in cooling solutions, and it's in the multi-utilities.
Kevin, it's always great to see you. And
as
stick
well.
around because we're going to hear from you later.
Yes,
in
I'm
the
going to give
show
you that other name.
as well. Perfect. Thank you, sir. All right, well, it is day 2 of Apple's Worldwide Developers Conference is taking place. That's in California. And joining us now from that conference is Yahoo Finance tech editor, Dan Howard. Dan.
Yeah, Josh, this is, day 2, as you said. Developers are still kind of milling around. Analysts and journalists like myself are also here. And there's some takeaways that we're getting from the event yesterday now. And so one of those is kind of based on Apple's approach to AI and how that's been kind of a slow trickle from the huge explosion that we saw last year with Apple Intelligence to what we saw this year, where instead of a new big splashy announcement, they had smaller bits of AI that they're weaving throughout their operating system. And it looks like that's going to be Apple's path forward, at least for now. Until we hear something about that new generative AI-powered Siri that it's supposed to come at some point either this year or next year. We're still not entirely sure. That seems to be the way that Apple can compete and potentially win this AI race that they have against the likes of Google and Samsung. I think one of the things that gets conflated because of the idea that AI is so large is comparing Apple's approach to something like a Microsoft, which obviously provides the majority of its AI services to enterprises. And yes, they do have consumers, but if you look at the balance, it's going to be on the enterprise side. And so they obviously compete with Google as well as far as smartphones, but really it comes down to the enterprise and what they can offer to advertising. So Apple's approach is going to be different naturally, but this way of kind of moving forward with the dribs and drabs, generally, it seems as though I got to see a few of these features they announced, really helpful updates. So it's not that, we're still seeing those, make emojis or things like that. But then there's also ways of adding functionality to existing apps with AI that so far seem to be pretty helpful for users.
Dan, here's my big question for you as a reporter who has followed Apple for a long time. Apple, not interested in being first, Dan. As you know, they are interested in getting it right and then succeeding in that market. So, and listen, that has proved to be a very successful tactic and strategy for Apple. Can Apple do that again, Dan, in your opinion, when it comes to AI?
I think they can, right? I mean, look, as you said, they've done this again and again. They were not the first with music players. I think the Microsoft Zune might have been before that, or maybe not the Zune, but there were things like mini disc players that tried to, make smaller music players, but then the iPod came out and it killed it. They weren't the first when it came to, smartphones or the idea of smartphones. There were ideas out there already, but they kind of just honed it and created the iPhone. And so same thing with, wireless earbuds and smartwatches or fitness trackers, what have you. They've done this over and over and over again. And it's their kind of MO where they let everyone trip over themselves getting out the starting blocks, right, to be first. And then they kind of take their time and provide products that don't miss, or more often than not, don't miss, and give general utility to users. And I think that's what they're doing here, right? So, some of the offerings that they have on include the ability to, create spreadsheets very quickly from recipes that you may have, and you need to scale that up for different aspects of what you may be wanting to do as far as parties go and things along those lines. So I think that those are really helpful rather than, the whole idea of let's take pieces out of images. They also spent a lot of this event catching up, really. So they have, Google has what's called Circle to Search. Samsung also offers it where you can circle something on your phone that you take a picture of or from your screen and then be able to search for it really quick. Now Apple has that in their visual intelligence app, and that's a truly helpful feature. I use something like that on my own to search for something, a flower that I had seen, wanted to know if it was bad for my cats or not. It turns out it was, got it out of the house. This adds to that. So I think that strategy could absolutely pay off here. Wall Street obviously wants to see a big, explosive, splashy announcement. They're not getting that yet. We'll see what happens when Siri comes out. And if Siri is even helpful as far as users go, are we going to want to use that on the daily, or is it just going to be something that we kind of, use for a minute and then fall out of love with the prior Siri? And then these smaller announcements become the more important ones.
We shall see. Still a lot of questions after this event. Dan, thank you. Appreciate it. We're just getting started here on Market Domination. Coming up, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into two stocks, help you make the best moves for your portfolio. We already teased. One of them is in defense. I'll tell you what it is next. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're diving into the aerospace and defense sector. I'm back here with Kevin Mahn, Hennion and Walsh CIO. Kevin, thanks for sticking around.
Yes,
as we talked about,
pleasure.
you like the defense sector. That
really
much
do.
we know.
Yes.
And specifically, there's a stock you like in it, and that is RTX,
Yes.
which used to be known as Raytheon.
Correct.
Now is known as RTX after some sort of restructuring. The stock is up some 30%. It's actually trading near a record. It's off that a little bit today, but pretty close to that record level still. So within RTX, you
Yes.
still have Raytheon as a big part of it.
Yes.
So talk to us about that.
So there's
business.
three different segments to RTX. One is Collins Aerospace, two is Pratt & Whitney, and three, of course, is Raytheon, the most appealing from an investment perspective. Why? Because they design and they manufacture air and missile defense systems. Think of the Iron Dome, similar to what Israel has and similar to what the Trump administration wants to build here. We believe they'll be a benefactor of all this increased defense spending, with the U.S. planning to spend up to $1 trillion on defense in the upcoming budget, and we think RTX will get a lion's share of that money.
Well, it sounds like you're not the only one who thinks this.
No.
Because the stock is done, like I just pointed out, the stock has done very well over the past year and is near a record. So
Yes.
do you think there is a momentum aspect to this?
Absolutely. I think a large part of that goes with the defense spending outlays,
Right.
what they're trying to build with the Iron Dome, and also this sector as a whole. You look at the number one performing sector in 2025, it's industrials. Guess where aerospace and defense falls under? Industrials, and that's what's driving it up. And there's other defense contractors that are going to benefit it as well, but I think RTX is particularly attractive.
And then let's talk about some of the numbers around the stock. The valuation, 22.9 times forward PE, little high,
Yeah.
but it does pay a dividend
It
of
does.
what is it, 1.9%.
Nearly 2%.
So you get something for paying up for it. I
Absolutely,
suppose.
and there's a lot of defense names right now that are trading at very high multiples. This is relatively in line with the S&P 500 from a current PE perspective, and you get a dividend yield of nearly 2%, and the stock's up over 20% year to date, and there's likely to be more defense spending coming their way. I think investors should consider the name.
So let's, we
It's a
always
good
like
buy.
to look at what a potential risk is. In this case, obviously the bill is now being debated. We could see tweaks, we could see changes. How big of a risk do you think that is?
I think it's a small risk, but it is a risk. And then going forward, yes, if we get the defense budget increased to $1 trillion for this year, does it stay at those levels, or do they pare back, and does RTX still benefit in future years?
The other thing I wanted to ask you about is competition here, because we have had this sort of push within the federal government to be more efficient,
Yes.
to be more sort of tech forward,
Yeah.
right? And you see some of the defense startups getting more attention. But do they compete sort of directly with RTX? How do they sort of all fit together?
I would say what Raytheon has in terms of air and missile defense system is far and above beyond their competitors right now. That's right now. But there's other defense contractors that are very similar. Take Lockheed Martin, the manufacturer of the F-35 fighter jet. But they didn't win the contract for the new F-47. Boeing did. So there's a lot of competition in this space right now as they try and make us safer, but do it much more efficiently and with less cost.
Well, speaking of sort of startups within the aerospace realm, that takes us to our goodbye, the stock that you're avoiding. Vertical Aerospace, EVTL is the ticker, which sort of stands for eVTOL, electric vehicle takeoff, vertical takeoff and landing here. So it's these sort of electric, sort of more helicopter-like aircraft that we've talked about. The stock, you can see here, is down over the past year. It's about 18%.
Never a good sign.
Why don't you like this one? We don't see defense buying.
They're not an
right
approved defense contractor to the U.S. Department of Defense. Electric aviation right now, it may be the future, but it's not the present, and there's a lot of competition in this space. And as you'll see in the next two areas, they're burning through cash right now. The stock's down 52% year to date. It's not a good story right now, and I hope it turns for this company.
Well, if it's not a defense play, could it eventually be a commercial play?
Certainly could, but they have to become profitable first. They have to actually start signing some large commercial contracts, and then they have to actually have this technology, this new groundbreaking technology work.
And then if you look at how this stock is done, it's the opposite of the upward momentum that we saw with RTX. This stock, I mentioned, it's down 18%. Over the past 12 months, it's down a lot more just year to date.
Just year to date, it's down over 50%. And what we saw with their their end of 2024 earnings, they lost a significant amount of money. You look at the forecast for Q2, they're expected to lose once again about 43 cents per share on earnings. That's not a good sign for a company that's trying to become profitable.
Yeah, as you say, they're not signing those contracts yet. So I guess it goes without saying, they don't pay a dividend
certainly
because
can't afford to
they're
pay a
not bringing
dividend.
anything in the door.
Weak balance sheet, not paying a dividend. It's hard to find anything to like with the stock right now. With the company and the idea and the concept makes a lot of sense, but they need to shore up their balance sheet.
Gotcha. So what could go right here? It could work out, right? So as you mentioned, there are a number of companies that are attempting to do this. There's Vertical, there's the likes of Archer Aviation and Joby that are all sort of jockeying to be the first, really dominating company in this space, but they haven't none of them have really gotten there yet. And maybe this one might be in third. I don't know.
Possibly. I mean, we're in desperate need of alternative power solutions in aviation, in automotive, and across, I'd say, defense contracting, and even in AI. The concept makes sense to me. There's a lot of competition right now. They're burning through cash. The stock's down 52%. They're not forecasted to grow in their earnings. And then I looked at the outtakes of their Q1's earnings reports, and they said they had enough cash on hand to last through 2025. Sounds comforting, but there's only 6 more months left in 2025. So hopefully it turns around. I don't see them being a recognized defense contractor. Maybe they'll sign a large contract on the commercial side, and this will start to perform again, but not yet.
Well, you don't own this one.
I do not.
Think it is fair to say you guys do own RTX.
We do own RTX.
Yes. All right. Thanks so much, Kevin.
Pleasure,
really
Jules.
appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern. Stick around. Much more market domination still to come.
Well, Waymo has emerged as a leader in autonomous vehicle technology and robotaxi services. Its roots, of course, are with Google as its self-driving car project, and Waymo has come a long way. Our senior autos reporter, Pras from Hennion, joins us now to talk about its success as a leader in this sector. Pras.
Hey, Josh. Yeah, you mentioned, so I started off as an offshoot of Google X and the X initiative back in those days, what they used to call it in 09. And after some testing and trying to get permits off the ground, in 2016, the project became Waymo. Started testing its Pacifica hybrids, and it took off from there. 2018, Waymo worked with Jaguar, paired up with them to get their I-Pace EVs in for testing. You see these now in the streets in LA and places like that. Waymo uses a combination of vision, radar, LiDAR, what they call multimodal. They claim this is the safest solution. Now, they have the most robotaxi miles driven and perform around 250,000 trips a week, right? So other rivals like GM's Cruise and AV tech companies like Argo AI, they're gone, leaving only a few competitors like WeRide and Pony AI and Zoox in the space. Now, challenges. They need to scale up. They have around 700 to 1,000 vehicles in major markets and can produce at their factory about 1,500 a year. An expert tells me that could be a bottleneck for them in the future. Whereas Tesla, right? Tesla with their big test coming up their start of their test unofficially on the 12th. If their hardware is sufficient, they have millions of vehicles on the road already. And when you pair that with their robotaxi software, you could see them easily overtake Waymo. That's a big if. Tesla's service is just beginning, years behind Waymo. And if Musk's big bet on a vision-only system paired with the neural network that Tesla built can take on and possibly surpass Waymo, there's still a lot to prove to see whether that can actually happen.
Now, Pras, have you taken a Waymo? And if so, what'd you think of the experience? I asked because I haven't.
I did. About a month ago, I was in LA and I took a Waymo in the western part of the city to a friend's place. And I was actually deeply impressed by it. I thought that it was a very slick, use the app to order the Waymo. It comes to you. It has your initials on the top of the little screen so you know it's yours. You open the door with the app. You close the door, get inside, and then you start the ride when you're inside the car. Hit the button on the app. All of a sudden, it pairs your phone. It says you can stream music. You can change the temperature to your liking. It's very pleasant. The cars actually whip around, I think, at a decent pace. It's not a slow thing, in my opinion. Got me where I need to be, and at a competitive rate to Uber.
Pras, thanks so much.
Thank you.
Trane Technologies is reaching milestones with its stock price soaring to all-time highs and the company reaching a market cap of more than $94 billion. It's the latest focus of our new series, The Why Behind the High, where we're taking a look at companies whose stock is at or near record highs. Trane is among them, with its business focused on sustainable solutions for commercial climate and HVAC systems. Trane Technologies chairman and CEO Dave Regnery joins us now. Dave, it's great to see you again as we look at the stock trading near record here.
Yeah, well, thanks for having me on your show again, Julie. I think every time I'm on your show, we tend to have a nice uptick. So I look forward to that today as well.
I like to hear that. One of the catalysts that I was looking at as I was trying to figure out what has sort of been propelling you guys higher, one of the recent catalysts was the last earnings report, which was at the beginning of May. Revenue there up by 14%. And I know you saw demand really across all of your verticals, and you guys cover a lot of different areas from commercial to residential, healthcare, education. I want to ask about data centers because we talked about this a little bit last time. Last October, I tried to get my arms around how big that business is. You said you hadn't yet disclosed it. What can you tell me about the data center business and its importance to Trane?
Yeah, well, we still haven't disclosed it, so I
Fair
won't tell you
enough.
the size of it. But I will tell you that we're very strong in that vertical. But I would also tell you that we're very strong in many verticals, not just the data centers. Which, if you look at the first quarter, or we had strong organic revenue growth, but yet our bookings still increased our backlog. So our backlog was up $500 million or 8%. And if you look across that backlog where we're building, it's really across many different verticals. So that gives me a lot of confidence that our teams are executing, and they're not just executing in data centers, but they're executing in many verticals for our customers.
And I do want to talk about those other verticals, but I'm going to linger for another moment in data centers, because I know there's a lot of competition in a lot of the verticals, but in data centers in particular, there's a lot of demand from the hyperscalers, as we know, who are building these things. And then there's a lot of jockeying amongst you and your competitors to offer those mainly cooling solutions for those buildings. So do you all feel you're taking market share there, or is it that there's so much to go around because of the data center boom right now that it's not that, sort of cutthroat, if you will?
No, I think it's certainly like any vertical. There's a lot of competition, and you have to be ahead of your competition. You have to be innovative and be able to do that. We've been strong in the data center vertical for decades, and we're going to continue to be strong well into the future. Let me give you an example of how we innovate. So this one just crossed my desk. We have a customer that I can't mention that's in Australia, and they have a learning data center. So it's a high heat data center, AI chips, and they want more efficiency. And in our world, we measure efficiency of a system by the coefficient of performance, or COP. And I won't get too technical on you, I promise, but the normal system in the HVAC world is a COP of 4 to 6. We developed a system for this particular customer where the COP is 10. That's really unheard of in our space. And again, it's this creative, thought process that we bring to the data center customers. We work well with their engineers. They like being in our labs and seeing what we can do. And we challenge each other. And when you do that, you come up with solutions that maybe you didn't even think were possible in the past, that we've now demonstrated that we can deliver for our customers.
Right. So you guys are innovating alongside many of those clients. I want to turn to residential as well, because there too you were continuing to see demand. And it's so interesting to me because obviously we look at the housing market, at least here in the US, which is also your biggest market. And it's a tricky market right now. So where is that demand coming from within residential, and is it remaining consistent?
Yeah, I think through the first quarter we did very well in the residential business. I would tell you that don't look at a quarter in residential. Okay, you need to look over a longer period of time, because some of our competitors have different ways to market, and they could be selling into a channel versus selling through the channel. But we had a strong start to the year, which is reassuring to us. We're seeing demand not necessarily in the new construction, because it's pretty obvious that's a little bit more challenged. It's really in the retrofit space. And let's face it, I mean, our distributors as well as ourselves, we've learned from last year that it was a very, very warm summer, and you need to make sure you have the right inventory levels so you can satisfy the customer demand when it hits.
And Dave, you mentioned the retrofit across your business lines. I'm curious how much you're relying on new construction and putting systems in new construction versus those retrofits that you're doing.
Yeah, in the resi space, it's less than 20% is new construction. In the commercial space, which is the predominant size of our business, it's probably more 70-30 there, 70 retro, 30% would be new construction.
And finally, I got to ask you about tariffs, because when you guys reported, the tariff outlook was unclear. It's still unclear. I guess you could argue it is less unclear. And you did talk about taking price where you were seeing tariffs and where you felt it was necessary. Can you give us an update on that assessment?
Yeah, I mean, as we said in the first quarter, we're a little bit different than many companies, right? We've had a strategy for decades here of in region for region. So we manufacture predominantly in the region that we sell. So for example, in the United States, we have 25 plants. About 95+% of what we sell in the United States is manufactured in the United States. And we encourage our supply chain to follow our manufacturing strategy. So we want them to be alongside us in the region in which we're manufacturing. As we said in the first quarter, look, the tier 2, tier 3 suppliers, We still have an impact. We sized it then at the 250 to 275, 250 million, 275 million. That number has obviously come down. We'll resize it when we announce the second quarter. And our first goal is to try to mitigate it. And if we can't mitigate it, we will use pricing actions to offset it.
And I guess to go back and sort of link it to the demand conversation, even if you're not seeing that huge of a direct hit, and as you say, it's lower now, what about among your customers, right? If they're building a new building, for example, they might be feeling it in different ways. So are you seeing any kind of changes in that sort of end market because of the tariff back and forth?
Yeah, I would tell you through the first quarter, we have not seen that. And you saw that with our order rates in the first quarter. Again, we built $500 million of backlog. Our backlog is at record highs at the end of the first quarter at $7.3 billion. So we haven't seen that impact. I think that, working with our customers, having them understand how we're trying to mitigate those tariff expenses for them on their behalf. We're not going to be making a profit center out of tariffs. I think it goes a long way, and the transparency that we're providing to our customers will be a win for the long term.
Dave, great to see you. Thanks for taking the time to chat with us.
All right, Julie, good to be here again. I look forward to a new high soon, okay?
Good luck. Take care.
Okay, take care, Julie.
And just a reminder, we're continuing to shine a spotlight on companies at or near record highs. Be sure to tune in this week to hear from NRG CEO Larry Coben and the CFO of Waste Management, Davina Rankin, coming up as well. All part of our new series and segment, The Why Behind the High. Stick around. We got much more market domination still to come. Time to take a look at some of today's trending tickers. We got our eye on Alphabet, Casey's General Store, and Flutter, all seeing their share prices rise today. We'll start off with Alphabet. It is seeing increases after reportedly striking a deal with OpenAI. This cloud deal coming despite OpenAI threatening Google's core internet search advertising business. It marks yet another deal that the artificial intelligence company has struck with major software and technology players. This is according to Reuters, by the way, that this is happening here. And it is interesting to see this happening. It isn't necessarily what you would expect.
So Colin Sebastian, very smart analyst over at Baird, put out a note on this, gave his thoughts, called this a high-profile win for Google Cloud. Likes this, says it also diversifies a key Microsoft partner away from that rival Azure platform. Ends by telling his clients, listen, it's unlikely near-term due to the obvious rivalry in AI answers, but a relationship between Google and OpenAI could eventually open the door to other strategic collaborations over time, in his view. Yeah,
it's pretty fascinating to see all of the back and forth that we're seeing amongst the various AI providers. I would mention, those Alphabet shares. We talked earlier in the day about how the Mag 7 has not recovered all the way this year. And indeed, Alphabet is still down nearly 6% so far this year. So they've come back from the lows, but they haven't gotten back into positive for the year.
All right, next up, let's talk about Casey's General Stores, which is seeing record highs after announcing a record-breaking fiscal year for that company. So fourth quarter earnings beat, reports showing strong fuel margin, growing market share. I do see RBC analysts cited as talking about the company's unique positioning in lower-cost geographies and small markets.
And guess what? Our Brooke DePalma today had the chance to chat with the CEO, Darren Rebelez, and he said what was behind this? It's just doing what we've always done pretty well, but just doing it at a higher level and doing it very consistently. He said, when you look at our growth pillars that we set out in our strategic plan a few years ago, we said, first, we're going to accelerate our prepared foods business, the crown jewel of which is pizza. So pizza, he points out, is a big driver for them. He said, aside from prepared foods, the other goals were to accelerate the store growth, so they've opened more stores. And he also said is to run the business more efficiently. So as they grow, they're trying to get more leverage out of the scale of the company.
Stock, up around 25% this year.
It's at a record.
Up around 50% over the past 12 months, and most analysts think it's going to move higher from here.
Yeah, a next why behind the high candidate, perhaps. Finally, we're watching shares of Flutter also seeing gains after it announced a 50-cent fee on all sports bets made in Illinois. It's, of course, the parent company of FanDuel, saying that due to that recent Illinois law taxing all sports bets, they'll be instituting a fee to offset the cost to the company. The leading online sports betting and gaming operator seeing the stock rise to its highest since February 28th. We're also watching DraftKings, which said it is trying to figure out. It anticipates taking action on this as well.
Yeah, it was interesting because just this week I saw Moffett-Nathanson, the team over there, publish a note on Flutter, and they were talking about sort of the different risks for the company, and they did include on the regulatory front these bills, several bills proposed at the state level to raise the tax rate on both online sports betting and iGaming, but ultimately, actually, they did reiterate the buy on this one. They said it's just in a unique position, they thought, to take growing share in the online gaming market.
Yeah, it doesn't seem like investors are worried about these transaction fees, certainly. Well, Eli Lilly revealing a caveat to its agreement with telehealth firms, including its recent deals with Ro and LifeMD. Yahoo Finance's Anjali Kamlani joining us now with more. So tell us more about this caveat, Anj. Anjali, I think you are muted.
I am muted. I am so sorry.
That's
Rookie
okay.
mistake here. You would think after the pandemic days, I would have got that covered. Okay, so Eli Lilly Bloomberg reported some details about Eli Lilly's agreements with these telehealth companies. And that includes, as you mentioned, some of the ones that are not the big names we know. So not Hims and Hers. And that is sort of the point of this mention, that Lilly has created a route to be able to get their product in with these companies while also ensuring that the compounded versions are not being sold on the same site and they're not competing with those compounded versions. Important to note, though, and we got a statement from Eli Lilly that they are actually helping their competitor Novo Nordisk out, because in the comment I got, it said, quote, anyone continuing to sell mass compounded tirzepatide or semaglutide products, including by referring to them as personalized, tailored, or something similar, is breaking the law. That's a direct quote from Eli Lilly. And the call out on personalized and tailored is because that is a loophole that certain compounded pharmacies are currently trying to use to keep these compounded GLP-1s on the market, saying that they don't entirely have to shut down despite the FDA bringing those products off the shortage list and therefore stopping compounded products. Now, this is interesting because we have seen a number of telehealth companies not just partner with Eli Lilly, but also Novo Nordisk and their telehealth platform. And Hims and Hers is currently partnered with Novo Nordisk. So it seems that that caveat was not part of the agreement there. So two different sort of competing strategies to try and compete with compounded products and get them off the market, or not at all in the case of Novo Nordisk. But this is the reason why that Lilly caveat is so interesting. There are some companies that are part of the platform that do continue to sell compounded products, and it remains to be seen how Lilly does manage those and how they go after them.
And on just to put a fine point on it, Hims and Hers, I'm looking at the shares are down about 3%, and it looks like it is indeed linked to this. Of course, Hims and Hers is also up like 128% this year.
That's right. Yes, they definitely have been benefiting from the GLP-1 boost, and one of the biggest ones that we can track as a publicly traded company. And that's sort of the benefit that they've had, is that no matter what has been happening in GLP plus telehealth world, they have been the benefactors of that in their stock price. And now to this point, when the sort of mask is taken off on some of these agreements, it comes down to whether or not Hims decides to join the entire rest of the community and the other telehealth players in taking down these compounded products, or whether or not they continue to sell them. I did speak to previously one of the telehealth companies, and they said that they had given their members a chance to buy sort of a year's worth supply of compounded products by the deadline, and some clients did take advantage of that. So there clearly is still a market for these products based on their price and who's trying to access them. But it seems like the companies are working with the authorities to try and do a better job of policing that and making sure that the branded products are the ones now on the market.
Anj, thanks as always for your coverage of the GLP-1 space. Appreciate it. While we're wrapping up today's market domination, don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.